Welcome to the lesson. Today we are going to answer question 5. This is December 2023. Question 5a reads, explain the following terms as used in behavioral finance. Roman 1, market paradox, 2 marks. Roman 2, herd mentality bias, 2 marks. Roman 3, loss aversion bias, 2 marks. B, one of the most notable qualitative model of predicting corporate failure is Argentine's A model score. Argentine suggested that the failure process follows a predictable sequence. Required, examine the 3 failure sequence processes as predicted by Argentine's model score, 6 marks. So let's take part A first. Explain the following terms as used in behavioral finance. Market paradox. Market paradox. We all know candidates refers to a situation where the behavior of investors or the overall market appears to contradict the rational expectations or the fundamental economic principles. You understand? It's a paradox, all right? And it is a situation where the behavior of investors appear to contradict the fundamental economic principles. All right, and that's it. Candidates were required to just state that to earn the 2 marks. And we know that candidates, these paradoxes often arise due to the cognitive biases and emotional influences that drive investors' decisions. So this is December 2023. December 2023, question 5. That's the meaning of market paradox. Then there is the herd mentality bias. Herd mentality bias. Herd means group mentality. Now, herd mentality bias, on the other hand, describes the tendency of individuals to mimic or to copy the actions of a larger group, even if those actions go against their own judgment or information. Herd mentality. Now, as used in investing, this can lead to investors buying or even selling assets simply because others are doing so. And that, in most cases, leads to what we call market bubbles. Market bubbles or market crashes because of the herd mentality bias. Do you understand? It is a tendency of individuals to copy others in making financial decisions, even when such decisions contradict their own judgment. So it's just following what the larger group is doing, the herd is doing. That's the meaning of herd mentality bias. Then we have the loss aversion bias. Loss aversion bias refers to the tendency for people to feel the pain of losses more acutely than the pleasure of gains. You understand? And that can lead investors to hold on to losing investments for too long hoping they will recover, or to sell winning investments too early, fearing potential downfall. Loss aversion bias. You understand? It is the tendency for people to feel the pain of loss more acutely than the pleasure of gains. Because we know loss comes with pain, and gain comes with pleasure. So there is that bit on loss aversion bias. For example, an investor may be reluctant to sell a stock that has declined in value, even if the fundamentals suggest it's unlikely to recover, because they don't want to realize the loss. And that can lead to missed opportunities and even further losses. Do you understand? That's the meaning of loss aversion bias. Loss aversion bias. Part B of the question reads, one of the most notable qualitative model of predicting corporate failure is Argentine's A model score. Argentine suggested that the failure process follows a predictable sequence. Required: examine the 3 failure sequence processes as predicted by Argentine's model score. 6 marks. All right. This model, candidates, was developed by Argentine. I think the other name is Frederick, if I'm not wrong. Frederick Argentine. And this model predicts that corporate failure unfolds in a sequential manner that is triggered by a series of interconnected events. Right? A series of interconnected events. So first of all, Argentine states that the first of the events is just defects. The process begins with the underlying flaws or even underlying weaknesses within the company. So Frederick categorizes the defects into groups. Okay? Let me put that down. That is part B of the question. We are answering the 3 failure sequence processes. According to Argentine, the process begins with the underlying flaws or weaknesses, which can be grouped into 2. We have the management weaknesses. A, management weaknesses. 2, weaknesses to do with accounting deficiencies, or accounting, let me just call them deficiencies. Accounting deficiencies. And candidates, here we are discussing corporate failure. There are many models that helps us understand the concept of corporate failure. One of them is Argentine's model score. So here, candidates, the defects are categorized into 2. This is management weaknesses and accounting deficiencies. So management weaknesses encompass issues like autocratic or incompetent leadership style, lack of management depth, poor succession planning, and so on. Generally, weaknesses in management. That is a defect. Then there is accounting deficiencies. These include inadequate financial controls, lack of budgetary controls, absence of cash flow planning, poor costing systems, and such like accounting deficiencies. And these defects create a fertile ground for future problems. This is how companies fail, candidates. When companies fail, the problem may be traced to initially weaknesses within management, the management team. Maybe the style is autocratic when it ought to be democratic, or it is democratic when it ought to be autocratic. So, because we all know that the leadership style depends on many factors. So, if there is weakness in management, that is a defect. Another defect would be accounting deficiencies. I've given examples: lack of internal control system, lack of budgetary control system, absence of cash flow planning, poor costing systems. You can name them. Accounting deficiencies. And these deficiencies then become a fertile ground where many problems are born. All right? Then the second stage in this sequence is mistakes. Mistakes. Now, as a consequence of the initial defects, all right, as a consequence of the initial defects which I have outlined, the company starts making strategic and operational errors. And these errors or mistakes may manifest in many forms. It could be high gearing, that's a mistake. It could be over trading, that is a mistake. It could be a failure of a major project. It could also manifest in a company diversifying in unfamiliar sectors or areas. You understand? Mistakes as a result of poor management, as a result of accounting deficiencies. The next stage is mistakes. I've given examples of high gearing. High gearing. This is excessive borrowing that leads to high interest payments and financial vulnerability. Overtrading. Overtrading. I don't know what overtrading is about. It's all about expanding too rapidly without sufficient resources or control, and so overtrading, expanding too rapidly without sufficient resources or controls, which then strains cash flows, and there could also be a strain on the operations of the company. Overtrading. I also mentioned diversifying in unfamiliar areas. Diversifying in unfamiliar areas. That's a mistake that a company can make, venturing into new markets or venturing into new industries without adequate expertise, which can then lead to losses and what we call strategic drift. That's a mistake. The company may also initiate a major project which may fail. Failure of a major project. Failure of a major project. Failure of a major project. A significant project failure can have a domino effect, impacting finances, impacting reputation, and even the morale of the employees. You understand? Then this is the first stage in the sequence. We have defects, mistakes. Then number 3, symptoms. 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 These are signs, okay? Because of the accumulation of mistakes, all right? The accumulation of mistakes gradually gives rise to visible signs of distress. Visible signs of distress. These are indicators, all right? As a result of these mistakes, then there are visible symptoms or signs that can be seen. You understand? These candidates, symptoms can include things like deteriorating financial ratios, things like board disputes, deteriorating financial ratios. These are symptoms of corporate failure. The company may also experience loss of key personnel. So when you hear candidates, the company is losing key personnel, there could have been a problem right from the first stage, defects, all right, which then metamorphosizes to mistakes. Then you see the symptoms, board disputes, deteriorating financial ratios. Key financial indicators like profitability, liquidity, solvency ratios start declining. Then we also have board disputes. These are disagreements and conflicts which may emerge within the board of directors due to mounting pressures. The company may also lose key personnel. These are talented employees who leave due to lack of confidence in the company's future. You understand? Another symptom could be qualified audit reports. Qualified or negative audit reports. The auditor may express concerns about the company's financial statements or even its ability to continue as a going concern. Now, at this point, candidates, if these symptoms are not taken seriously, if the symptoms are not addressed, right? If the symptoms are not addressed effectively, the company then enters what we call a full-blown crisis. Number 4, crisis. Crisis. A full-blown crisis. A full-blown crisis. This is another stage that is characterized by acute cash flow problems. You start hearing the company is unable to pay the creditors, The company is unable to pay employees. Employees have not been paid for 9 months. The shareholders have not been receiving dividends. Other operational expenses are not being met. The company has not paid even short-term liabilities as a result of acute cash flow problems. This is the inability to pay creditors, to meet financial obligations, and so on. Then this crisis also is characterized by loss of customers. Loss of customer. Let me say loss of customer confidence. Loss of customer confidence. Loss of customer. Let me add supplier confidence. The customer start losing confidence in the company, right? And this could include even business partners becoming hesitant to engage in transactions. The crisis may also be characterized by legal actions. Legal actions. Legal actions. Creditors, because they have not been paid, employees have not been paid, you hear they rush to court, all right, so that they can pursue their dues. Because here we say that there is acute cash flow problems, creditors are not paid, employees are not paid. So at that stage, the crisis stage, this stage is characterized by legal disputes or actions. Creditors or even other stakeholders may initiate legal proceedings to recover their dues. All right? Then, of course, the last stage here is failure. Failure. You understand? The final stage is corporate failure, which can take the form of bankruptcy, it can take the form of liquidation. Failure can also take the form of acquisition by another company. So these are 5 key stages in the failure sequence process. You understand? Yes. Now let's move on to part C of the question. It reads, the current share price of Non-Op Limited is 7 shillings. Additional information number 1, the continuously compounded risk-free rate of interest is 8% per annum. Number 2, the variance of the rate of return on the share has been 12% per annum required. Using the Black-Scholes option pricing model, estimate the value of a European call option on the shares of the company that has an exercise price of 6 shillings and 60 cents and has 3 months to run before it expires. Note, the Black-Scholes formula is given as follows. So you have the price of the call formula there. So candidates, I will give you, now that the formula is provided, the examiner was generous enough to give you the formula. PC, we have the formula PSND1 minus X exponential constant raised to negative RT times ND2. That is the main formula. So we'll have workings. The first working is to calculate D1, which you are given in the question, natural log times PC over X plus RT. This is RT, standard deviation squared, which is this is the variance times T. Okay, that is D1. D1. Is that true? We divide all these by standard deviation of square root T. And candidates, the formula for D1, it's one fraction. It's not as presented in the question. That line, it should be over standard deviation times square root of T. Standard deviation times square root of T. Do you see that? So that is the formula. These values are to be obtained from the question. Natural log. So we have we can substitute here the natural log into 7 over 6.6 plus 0.8 plus 0.12. Convert the rate into decimal, divide by 2. This we multiply by 0.5. Divide by the square root of 0.12 times the square root of the variance 0.25. So what is the natural log here? Ayak, give me the natural log of 7 divided by 6.6. What is the natural log? Give me the natural log. 0.0588. 0.0588 plus, remove the bracket, remove this bracket, remove the bracket. Give me the product. 0.8 plus 0.12 over 2 times 0.5. 0.08. Yes, convert into decimal. 0.80. 0.08. So remove the bracket. T should be 0.225. 0.25. Betty says 0.25. Now give me the value. 0.08 plus 0.12 over 2 times 0.25. Hope says 0.035. 0.035. Give me the denominator. Square root of 0.12 times the square root of 0.25. 0.1732. 0.1732. 0.1732. Is that so? Then simplify it. Simplify. 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 D1 will be equal to, Betty says 0.5416. Round it to 2 decimal places. 0.54. That is D1. Then D2, what is the formula for D2? Formula for D2 is D1 minus the standard deviation T square root of T. Is that so? We have 0.54. Is that what you did? Yeah, the formula is given. The formula is given. Candy, the formula is given here. Formula is given here. D2 is equal to D1 minus the standard deviation times the square root of T. Standard deviation times the square root of T. So what is the D2? D2. Kevin says 0.037. Is it equal to 0.037? 0.37. 0.37. 0.37. Now, do you have the tables? Standard normal tables, so that you can read from the tables ND1, ND2 from the tables. From the tables. What are the values? The normal, standard normal tables. You can read directly from the tables. I think I have mine. I have my table here. I can read directly. 0.54, 0.37. Read from the table. I'm reading from the cumulative standardized normal distribution. The one that has one side. But the one that is divided, you'll have to add 0.5 to the answer you read from the table. So ND1, what do you get? Page says 0.7054. That is true. I can confirm that. 0.7054. How about 0.37 from the tables? 0.6443. 6443. 0.6443. So we have the values. So we can then plug into the main formula. PS is 7 times ND1, that is 0.7054. All right, this we multiply, minus X is 6.66 exponential constant, we multiply by the exponential constant RT, okay, RT, this, we get that one value, and R we have it. Let me just substitute. We have the rate, is it not 8%? Convert it into decimal. This is exponential constant raised to negative 0.08 times 0.25. Get that value first, then we multiply with the ND2, which is 0.66. This is 6443. So can I have the answer? If you are using this table, the standard normal distribution table, okay, if you are using this one, you'll have to add the 0.5. All right, you have to add the 0.5. The one that there are two normal distribution here, you'll have to add the 0. But if you are using the cumulative standardized, if you are using the cumulative standardized, cumulative where you have just one, then you read direct. You understand? Yes, you read direct. Should give you the same answer. So what answer do you get? Page says 0.7696. 0.7696. Round it off to the nearest cent, because these are cents. This should be 0.77 shillings. With that, we are done with our today's lesson. Please, if you have any question you would want us to do, please feel free to communicate. Because right now I'm imagining which questions to do, and I should be doing the questions that you want me to do. Gave you that leeway because we had done 2024. We now completed 2023. If there is a question you have challenge with, you can always request us to do it. You don't have to score 100%. The pass mark is just 50%. It may drop to 40%. And you can see every question here. There are theory questions like the one we did today. These are 12 marks. Question 5, theory, 12 marks. Question 4, 8 marks. Total, 20. Question 3, 6 marks. That is 26 marks without using the calculator. December 2023, there are 26 theory questions. Assuming you only even just score 20, then you're only required to raise 30 marks out of the other 4 questions. So then, candidates, let's meet next time. In case you come across any other problem before then, communicate so that we help you out as you prepare for exams. Bye-bye.